$65 billion. Vanished. Not lost in a crash, not seized by a government, not hacked in a cyber attack. Stolen. Quietly, methodically, over decades. By one man, operating out of one floor of a building in Midtown Manhattan. His name was Bernie Madoff. He was a former chairman of the Nasdaq Stock Exchange. He was trusted by banks, hedge funds, charities, celebrities, and sovereign wealth funds across the world. And he ran the largest, longest, most devastating Ponzi scheme in the history of human finance. This is the full story. Bernard Lawrence Madoff was born on April 29, 1938, in Queens, New York. He was not born into wealth. His father ran a sporting goods business. His mother, Sylvia, briefly ran an unregistered brokerage that was shut down by the SEC, a detail that would prove darkly prophetic. Bernie was bright, ambitious, and driven by a single obsession. He wanted to be taken seriously on Wall Street. In 1960, aged 22, he founded Bernard L. Madoff Investment Securities with $5,000 he'd saved from summer jobs, installing sprinkler systems, lifeguarding on Long Island. His wife Ruth's parents lent him additional capital. The firm started as a penny stock trader, and in its early years it was genuinely innovative. Madoff was an early pioneer of electronic trading, a system that would eventually become Nasdaq. By the 1980s, his firm was handling up to 10% of all trading volume on the New York Stock Exchange. He served 3 terms as chairman of Nasdaq. He was respected. He was establishment. He was, by every visible measure, the real thing. The fraud lived on the 17th floor. Madoff's legitimate market-making business occupied the 18th and 19th floors of the Lipstick Building at 885 3rd Avenue in Midtown Manhattan. The investment advisory arm, the part that managed client money, was below them on 17. It was deliberately kept separate. Employees from the upper floors rarely went down. The 17th floor had its own staff, its own computers, its own printers. It generated its own account statements, its own trade confirmations, its own audit trails. None of it was real. Frank DiPascali was Madoff's chief lieutenant on 17. He had no finance degree, no license, no formal qualifications. He had joined Madoff straight out of high school in 1975 and spent the next 30 years fabricating trades. When a client requested a specific return, DiPascali reverse-engineered what trades would have produced that return, then printed the paperwork. When auditors asked for confirmations from the depository trust company, they were given forged documents. When the SEC came to visit, Madoff moved people around, created fake trading records on demand, and charmed the examiners personally. He was examined 8 times over 16 years. He passed every time. The strategy he claimed to be running was called the split strike conversion, a legitimate options strategy. It was plausible enough that sophisticated investors didn't ask too many questions, and the returns he promised were never outlandish, typically 10 to 12% per year, consistent, never spectacular, never suspicious. That consistency was the point. In a market that gyrated wildly, Madoff's numbers never moved. That should have been the red flag. Instead, it was the selling point. Madoff's client list reads like a directory of 20th century wealth. Fairfield Greenwich Group, a feeder fund, had placed over $7 billion with Madoff, nearly all of its assets. Kinggate Management, $2.5 billion. Tremont Group, $3 billion. Ezra Merkin's funds funneled in money from New York University, Yeshiva University, Elie Wiesel's foundation. Steven Spielberg's charitable foundation lost money. Banco Santander's clients lost over €2 billion. Even the Royal Bank of Scotland had exposure. The mechanism that made Madoff possible was a network of feeder funds, private investment vehicles that pooled client money and handed it over to Madoff wholesale. Their managers collected fees for doing nothing except maintaining the relationship. They had no incentive to look closely. And because Madoff refused to allow his clients to access his positions directly, claiming it was to protect his proprietary strategy, nobody ever verified the trades actually existed. Half his revenue, almost all his profit, coming from a floor of an office building where no real trades had taken place in decades. One man saw it in 1999. He tried to warn everyone. Nobody listened. Harry Markopolos was a quantitative financial analyst working for a rival firm in Boston. His boss asked him to reverse engineer Madoff's strategy so the firm could replicate it. Markopolos sat down with the numbers. He later said it took him 4 hours. The math was impossible. The returns Madoff claimed could not have been produced by the strategy he claimed to be running. The options market he would have needed to use wasn't large enough to accommodate his positions. The consistency of his returns through multiple market crashes was statistically impossible for a legitimate fund. In 2000, Markopolos submitted a formal complaint to the SEC's Boston office. He detailed exactly how the fraud worked. He explained the math. He listed the red flags. Nothing happened. In 2001, he resubmitted. Nothing. In 2005, he submitted a 21-page document titled "The World's Largest Hedge Fund is a Fraud." He named Madoff. He gave the SEC a step-by-step breakdown of exactly how the scheme operated. The document was read by one SEC examiner who found it credible, and then it was filed away. In 2006, Markopolos contacted the SEC again. Still nothing. There is no innocent explanation. That was the phrase Markopolos used in his congressional testimony after the collapse. He had handed the SEC a map to the fraud 6 years in advance, and the SEC's response was to do nothing, because Madoff was charming, connected, and gave them documents that looked right. The same instinct that made investors trust him made regulators trust him. The institutional failure was total. The end came quickly when it came. In September 2008, Lehman Brothers collapsed. The global financial system froze. Investors everywhere began pulling money out of anything they could. Madoff's clients submitted redemption requests totaling $7 billion. He didn't have it. He had almost nothing. On December 10th, 2008, Madoff called his sons, Mark and Andrew, who ran the legitimate trading business, into his apartment at the Lipstick Building and told them the advisory business was a fraud, a giant Ponzi scheme. He said he was finished. His sons contacted a lawyer that night. The lawyer contacted the FBI. The following morning, December 11th, 2008, federal agents arrived at Madoff's apartment. He didn't run. He didn't deny it. He said, "I knew this day would come." He was arrested, charged, and released on bail. On March 12, 2009, he pleaded guilty to 11 counts of securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering, and perjury. He was sentenced to 150 years in federal prison. The scale of the aftermath was staggering. Over 40,000 victims in 136 countries. Charities wiped out overnight. Pensioners who had trusted Madoff with their entire retirement savings left with nothing. The Elie Wiesel Foundation for Humanity lost $15 million, virtually all of its assets. Ruth Madoff, Bernie's wife of 50 years, was allowed to keep $2.5 million after surrendering all other assets. She changed her name. She moved to Connecticut. She has not spoken publicly about her husband since. Mark Madoff, Bernie's eldest son, hanged himself on December 11, 2010, exactly 2 years after his father's arrest. He was 46 years old. Andrew Madoff died of cancer in 2014, aged 48. He had said publicly that he believed the stress of his father's arrest had accelerated his illness. Bernie Madoff died in federal prison on April 14, 2021. He was 82 years old. The court-appointed recovery trustee, Irving Picard, has been unwinding the estate ever since. By 2024, he had recovered and distributed approximately $14.7 billion to victims, roughly 94% of the cash actually deposited. The fabricated paper gains, the $65 billion number, were gone. But most of what people had actually put in had, in time, been returned. Madoff didn't steal with a gun. He stole with a reputation. He understood something fundamental about how trust works in finance, that a man who looks credible, sounds credible, and has been verified by enough credible institutions will be believed, almost indefinitely, by almost everyone. Every major fraud in history, every one, is eventually unraveled by one person who couldn't let it go. For Madoff, it was Markopolos. He was ignored for 9 years, investigated, threatened, dismissed, and eventually proven right. One man saw it. 9 years. Nobody listened. Next week, Wirecard, the German fintech that convinced all of Europe it was worth 24 billion euros, while hiding the fact that nearly 2 billion euros of its cash simply didn't exist. The CEO wore a black turtleneck and talked like Steve Jobs. The regulator protected the company from its critics, and one journalist at the Financial Times spent 6 years trying to prove it was all a lie. Sound familiar?